Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, June 29th, 2020, and I am pre-recording this Trading Places Live for Tuesday, June 30th. That will represent the end of the first half of the year. Currently, we're looking at futures that are a little mixed as we head for Tuesday. NASDAQ showing a little bit of strength, a couple of spots of good news in the semiconductor group. But the Dow and the S&P look like maybe they're going to pause a little bit, but it's way early. We'll see what happens overnight. It was nice to see the overall market rebound, and we're going to get into all of that in just a minute. Our agenda for this particular webinar, I'm going to get into the daily market recap, take a look at the action on Monday, get into talking technically. I'm actually going to talk a little bit sentiment and pull up a couple of sentiment charts and show you how they impact the market and what we might be able to expect going forward from that. Then sector analysis. I want to get specifically into consumer discretionary. This is a group that's been very strong relative to the S&P since back in March. And I'll go through the industry groups within the sector that I think you need to keep an eye on. Earnings spotlight. We got one of the big semiconductor stocks reporting after the bell. Talk a little bit about that. Pretty good report. And then we'll wrap up the show today with 3 you must see. These are all very interesting charts. One in particular I sent out to Earnings Beats members earlier today because I thought we could see a reversal, and I think we got that into the close. So I was anxious to see how the earnings information would come in after the bell. And not on this company, but one of its fellow semiconductor companies. And the results came in pretty good. But anyway, I'll get into all that when we get into the 3 you must see at the end of the show. Before I get started, though, I do want to just point everyone over to earningsbeats.com. Hey, make sure you subscribe to our free Earnings Beats Digest if you're not already a subscriber. It's free, no credit card required. Name and email address, hit the subscribe button. I'm pretty proud of what we do at Earnings Beats and our performance there. If you look over on the right-hand side, you'll see this is an up-to-date performance guide of our various portfolios. And our model portfolio, which is kind of our flagship, we started back in November of 2018. And you can see since that time, we're up almost 95% on this portfolio. The S&P is only up 13%. It's really just a process, doing your homework, finding companies that beat top line, bottom line estimates, and then make sure that they're liquid companies, that they trade a certain amount of volume, and then look at the technicals, look at the charts, look at the relative strength. A lot of the same things we talk about in the Earnings Beats Digest free newsletter, a lot of that goes into selecting the stocks that go into our portfolios every 90 days. So anyway, if you're not already a subscriber, I'd encourage you to do that and begin to see how we approach the market. I think, I'm not saying you want to change the way you look at the market. You might be very successful, but I do think this is something that could add to your current technical arsenal or maybe fundamental arsenal. Being a former practicing CPA, I actually like to use both. I like the fundamental information, but I also like the technical information. And so I think you probably enjoy the free newsletter. So go to earningsbeats.com, sign up if you haven't already. All right, let's get into the daily market recap. Really good day on Wall Street. Sometimes Mondays can be a little rough, but as we get close to the end of a calendar month and into the early part of the next calendar month, there is a tendency for the market to move higher. And we know that we have new money that comes into the market at the beginning of the month. Got a lot of 401k plans, a lot of withholdings and so forth that get sent in at the beginning of the month. Portfolio managers, hedge fund managers and so forth, they all know that. So you get a little buying ahead of time. I always call it legalized front running. Money's coming into the market. A lot of times you go in late in the month and start buying, and then the money flow kind of comes in on the heels of that. I think that was part of what we saw today. So the Dow Jones Industrial Average today up 600 points, the S&P 500 up 44, NASDAQ up 117, Mid caps up 40, the S&P 600 small cap up 31 points. On a percentage basis, small caps up 4% today, very strong. Mid caps up over 2%. The Dow was up over 2%. Boeing had a strong day, helping to lead the Dow higher. From a sector perspective, we had all 11 sectors moving higher on Monday. Industrials were the leader, but that's Boeing. Boeing's a big part of the industrials, and so Boeing gave this group a big lift, gaining more than 3.25% on the XLI. Also, we were testing a kind of a channel line. If you connect the highs and then drag that slope of the line down to this low back in March, you'll see that we were basically right at that key support area, channel support. So I'm not surprised we got a bounce. I think we got room to run here on the industrials. Materials, discretionary, there you can see both consumer groups, discretionary and staples, both doing very well, gaining about 1.9% each. And then utilities also up near 1.9%. But as I mentioned, all 11 sectors up today. It was really a nice day. Some of the new leaders that we've seen over the past few months, stocks like Zoom, DocuSign, some of those types of stocks struggled today as we saw money rotating out of those names and into some other names. But overall, the market did really well today. All right, let's move on to the 10-year Treasury yield. I like to see what's going on in the Treasury yield simply because it gives me that, I can kind of visualize the rotation that's taking place between bonds and stocks. And I'll be honest, I mean, the one thing or one of the things that's negative is we have seen a breakdown here. I'm going to show you a trend line. If you go back and you connect the candle bodies, which is what I like to connect, you'll see that we had a pretty solid trend line going up. And here, just over the past couple of trading sessions, we've broken back down below that. We also had some yield support around 0.65%. And I can show that right here. So you see these tests coming down, 3 different tests to 0.65. Well, we've gone just below that. I mean, we really need to see the 10-year Treasury yield move back to the upside. Not that if it keeps moving lower, the stock market has to come down, but what it's telling us as the yield goes down is that more and more money is rotating into treasuries. Every dollar that goes into treasuries is a dollar that can't go into equities. So we just got to be, a little careful here and watch this, because if we keep trending lower on the 10-year Treasury yield, it's just going to make it that much more difficult for stocks to really move appreciably higher. So keep that in mind as we go forward. That's something I would continue to watch on a daily basis. It's the reason I talk about this every day during my shows. All right, let's move on to talking technically. And in talking technically, I'm actually going to shift gears a little bit and talk a little sentiment. The 2 sentiment indicators that I like to watch, I like to watch the equity-only put-call ratio and the volatility index. Now, the equity-only put-call ratio, this gives us a pretty good idea. And again, I'm looking at equities only. I'm not worried about index options. There's a lot of strategists out there that use index options as hedges, as part of an overall trading strategy. I'm talking about the equity-only put-call ratio because I think that's more of a sentiment gauge of retail traders. And usually, these type of sentiment indicators are contrarian indicators. So when the market is all in on one side of the trade, that's usually when the market's going to reverse, or at least it is alerting you to the possibility. I don't like to be investing with the herd. I would rather be, maybe on the other side, especially when these sentiment indicators start to reach extremes. So if you look at this, this is a 5-day moving average of the equity-only put-call ratio. And the way you set this up at StockCharts, by the way, is if you come down here under type of chart, usually I use candlesticks, but if you use the invisible, the daily back and forth does not show. It's invisible, so you're not going to see it on the chart. And then if you put an overlay of the 5-day moving average, that's what's showing here. So this is just the 5-day moving average. Then down below, I've got the price action of the S&P 500. Now, anytime the market gets extremely fearful, that means a lot of puts are being bought. Everybody believes the market can't go anywhere but down. And when you see that these extreme readings coming in on the equity only put call ratio, the high readings, it's telling you a lot of puts are being bought relative to calls. And when you're buying puts, you're thinking the market's going to go down. And usually the masses will chase. So a lot of times when you get, big moves down, like here back in 2008 to begin the year, first quarter, we had this move down. You can see the 5-day moving average of the equity only put call ratio went to 1. That marked the bottom in the S&P 500 just for a while. Then we rolled back over, and you can see back in this was in November. We set a record. That was the highest 5-day equity only put call reading ever. That was the highest 5-day reading ever back in November of 2008. And of course, we bounced into year end. But that was the highest reading until March of 2020. We actually saw the 5-day move higher than we had back in 2008 during the financial crisis. And if you notice, that coincided right with the bottom. So when everybody thinks that the market can't do anything but go down, that's when it goes up. And that's what you want to take away. Now, for me, I find extreme pessimism to be much more reliable as a reversing indicator than extreme complacency. The market goes up a lot more than it goes down. We don't generally have a lot of fear in the market, but when we do, we can use it to our advantage. Now, if you look at these extreme complacency readings when the market is very bullish, I mean, here was the 5-day moving average near 0.4. That was right at the top here, and we went back down. Recently, you can see we got to 0.4, and we backed off of that level. Now, this doesn't tell me, I'm not looking at this to be an all-time high on the market or a top that where we're going to have a bear market for an extended period of time. But we do need to at least recognize that the market was just getting too excited about the prospects going forward. And as a result, the market pulled back. Everybody was buying calls. Usually options players, when you just keep buying calls and calls and calls, the market's going up, usually you get that reversal, and we've seen that. So I'm not overly surprised that we're pulling back a little bit. In fact, I've been issuing some warnings here of late, last couple of weeks. Listen, longer term, I think the market's going higher. I think we're going a lot higher. Short term, as a trader, though, you have to be aware of periods when we could see some consolidation. I think we've gotten that. As we actually head toward earnings here over the next few weeks, I think that could change. And after hours tonight, we had Micron come out, and not only did they beat top and bottom line, but they also raised their guidance going forward significantly. Their next quarter earnings were only supposed to be 80 cents. They just said they're going to be 95 to 115. When you start raising guidance like that in a low interest rate environment, it really changes the valuation of companies going forward. Micron, not surprisingly, up after hours. Also, Xilinx, another semiconductor, came out after hours and raised their revenue forecast. This was a stock that I recently talked about, broke out of a bottoming reverse head and shoulder pattern and moving higher. So I think earnings could lead us higher in the near term, although we are going to have to watch these recent highs that just went in. All right, one more sentiment indicator. Let's talk about volatility real quick. So the VIX, very similar to the equity only put call ratio. It's a contrarian indicator. So when the volatility index is moving up and gets to highs like we saw in 2008 and again in March of 2020, they tend to mark major bottoms. All right. And then when the VIX gets overly complacent, it can become a problem for the market. Although once again, I feel like panic really establishes a bottom more so than complacency establishes a top. That's just based on my experience. But I'm not going to ignore when we get really complacent markets either. Something to keep an eye on. But right now, the volatility index, the 5-day moving average, is still up in the 30s. And you can look back over the last 15 years and count on one hand, basically, the number of times that we've gotten up into this level. So for those that think this market's going to go lower, I think there's, I'm not going to say no chance because there's no guarantee, but the market is so fearful still. That usually keeps support under equity prices. You know, I mean, I just don't see it. I don't see the VIX right now being up at 32. Could we have impulsive moves to the downside because the VIX is higher? Yes. But we're already fearful. The market is already fearful. The bottom that was established came out of a VIX that was back, at 12 or 13. I think we're on our way down in the VIX. Very similar. We had spikes. We have short-term spikes when the market, starts rebounding, but they're not long-lived, and we start rolling back over, and that's what I expect here. I think that the market goes higher down the road. Maybe we consolidate over the summer. Maybe we even pull back a little bit. I don't look for those March lows to hit ever again. And you heard it right. I said ever again. I think that was a lifetime low that we saw with extreme panic. When we saw the lows back in 2008, 2009, we never went back down there again. When you see a VIX in the 80s to around 90, which is where they were where it was in 2008 and 2020, they mark bottoms. All right, let's keep moving. So I want to go over consumer discretionary. And first, let's just look at the absolute chart. Now, this is my sector analysis. I just want to look briefly at what's driving consumer discretionary stocks. So here you can see consumer discretionary bottoming back in March, making a run for the high that it had in February, barely getting there, and then rolling back over. I think this is a area where I would expect to see a little bit of a pullback. When you get back up, you lose 30% to the downside, maybe even close to 40%. When you get all of it back, that's going to be a resistance area. That's where all the selling began. So when you get back up there, you got to get back through that key resistance and all those sellers. Usually that doesn't happen on the first go round. So we went back down, put a low in around 122. Earlier today, we got down to 122 and change. I think this is an area of short-term support. If we lose this and the 50-day moving average, that's when I think we could be looking at additional pullback. Until that happens, though, I am not going to sit back and expect it. I think we are in a secular bull market. I think the market's going higher. And when you look at this, not just the absolute chart, but I'm going to show you the relative chart. Look off of the March bottom. This is the XLY relative to the S&P 500. When we have an economic cycle that's rolling over and we're heading for a bear market, money doesn't go into consumer discretionary stocks. Money comes out of consumer discretionary stocks. This is not a bear market driven by an economic cycle. We had a cyclical bear market driven by a virus that is hit. We're dealing with it. We're suffering from it. It's a health crisis, no doubt. But on the other end of this, I see a strong economy. I see the market moving higher, and I see charts that are agreeing with me. Consumer discretionary doesn't do this right before a major bear market. It just doesn't. It does this, and we definitely saw the move down in consumer discretionary on a relative basis before the crisis hit. But since we hit that low, look at what consumer discretionary is doing. This is pretty bullish. So what areas are driving this? Well, I'm going to go through them pretty quickly here, but we've got toys. Look at on a relative basis. This is toys relative to the S&P 500. Look at it moving up. Here was the February move starting in February. This is a group that's been on fire. How about, actually I could, let me do it this way. How about home improvement? Well, once again, in March, didn't look so good heading into, February and March, the end of last year. But from that bottom, home improvement stocks have just taken off on a relative basis. That's very, very bullish. Let's go on to specialty retail. Specialty retail. Look at this off of the February low. Huge move up, even through the pandemic. folks were turning to specialty retailers. Many of these specialty retailers have good, solid online presences. They were ready for this. This kind of fell right into their lap. So if you have an online presence, you probably did pretty well on a relative basis through March and April because you had a leg up on your competition that was brick and mortar. So specialty retail doing very well, continuing to do very well. Let's see, next one that's doing very well, broadline retail. Many of the broadline retailers, in February and March, look at the huge rise in the first half of March when the market was getting killed. This is one of the best areas of the market. All right, so, excuse me. So we have continued to move to relative highs. That's a good thing. So broadline retail absolutely would continue to be on my radar. Let's go to autos. I really like Tesla. Tesla is one of my favorite stocks in the market. A lot of times you're either on one side or the other with Tesla. You got folks that really like Tesla, and you got others that really just don't understand the valuation. I think Tesla is going to grow its earnings very rapidly. And I think as a result, they're going to command tremendous PE multiples. And so the automobiles going up, I think a large part, it's due to Tesla. Tesla had a really good day today, sending the automobile index out to another relative high versus the S&P 500. The last one, the sixth one that I think has really done well, recreational products. And you can see heading into March, at first it was not good, but I think a lot of folks took a step back and said, you know what, there's a lot of companies in recreational products that are likely to do extremely well. And so the huge recovery from the lows back in March, recreational products have just been absolutely on fire. You can look at that relative PPO. You get a relative PPO over 6. I mean, again, this isn't just that recreational products are moving higher. It's that they are crushing the S&P 500. And a relative PPO reading over 6 tells us that there is just tremendous momentum in this group right now. So those are the 6 areas that I think are really carrying consumer discretionary. But there's a couple of others here that I think are worth mentioning because they're on the cusp of maybe joining those 6. One is home builders. Home builders took that big hit in March, just like home improvement, but it has been coming back. I'm looking to see if we get another breakout. Look at the relative PPO just moving into positive territory. Starting to see that relative price action turn back up again. Low interest rate environment. If the economy does strengthen, this is a group you've got to keep an eye on. And then the last one I want to talk about is footwear. Footwear has had multiple tests of relative resistance. Haven't been able to break through. You can see this sideways action now for a year and a half. PPO, relative PPO near the center line, although we are slightly positive. Looking for this breakout. I'm just waiting for it. Get through that 0.59 level, and then I think you got another group you have to consider in this area. All right, let's move on to earnings spotlight. I mentioned Micron. I'm going to give you an update here after hours, what it's doing. And you can see it's up over 5.5% after hours, doing extremely well. And when we pull up the chart, it was kind of right on this trend line. I mentioned I don't remember if it was on the show earlier this morning. I think it was on the show earlier this morning that I did over at Earnings Beats. But this was a key area of support that I wanted to see hold with Micron. And after hours, we're getting that move to the upside. I think we're holding. Things are looking much better. Keep in mind also, this Micron, this is one of the worst performers in the semiconductor group over the last 6 months. And Xilinx, which came out with their raised forecast, look at the relative strength here. These are 2 of the weakest semiconductors, and look at what they're doing here. Very, very impressive. We could see a pretty nice rally in the semiconductor group on Tuesday. All right, I'm going to wrap up with the 3 you must see. And I'm going to start off with a semiconductor, AMD. This is one that I reported to our members at Earnings Beats today. It was threatening a breakdown below these prior lows, but it was starting to reverse. And I specifically highlighted that. And I said, many times these bottoms on stocks will form when you have a false breakdown and a reversal. So with that good news after hours, if we look at the after hours price on AMD, you can see we're up almost 3%, up $1.47. This looks like a kick save to me. And when I say a kick save, I mean it looks like we had a breakdown, but it wasn't sustained into the close. We got a reversal. When you break below, that triggers a lot of stops. And when you get a reversal, I can tell you, when I see a breakdown, I have no inclination whatsoever to buy during a breakdown. Most technicians wouldn't touch it. So why does it reverse? It reverses because market makers reverse it because they're building positions for institutional clients. That's normally why you get these reversals. So when you see a reversal like this, after it had a big breakdown, that can, not always, no such thing as a sure thing, but that can mark a very, very important bottom. I expect to see higher prices on AMD. Next up, INSG. This is one of my favorite stocks. I will tell you right now, I own this. Been waiting for today. Finally, we got the move up, got the breakout above this May reaction high. I think we got an uptrend, and this is going to be the right side of a cup forming. I'm looking for the stock to go back to $15. It's at $11.76 today, but the volume's been picking up. Notice also here, see how we kept going above, below, above, below the 20-day moving average? See all these false breakouts and back down? That is the poster child of a directionless stock. There's no trend. When you're constantly going above and below the moving averages, you have no trend in play. When you're rising above moving averages, that's when you're trending. Well, since we broke here at the end, well, maybe about a week and a half ago, we got through the 20-day. Notice we keep holding this 20-day moving average, and now we break to a new high. Volume is strong. We break out above this prior high. I think INSG is going to make a run. Wanted to point it out as part of the 3 you must see. But again, I do own this, full disclosure. And the final one I wanted to point out is MSI. Motorola Solutions, let me just say that this stock is not impressing me. And I wanted to point out because on this move down in March, accumulation distribution was rising. And that was one of the things I was looking at and would have said to me, hey, this could be a really great play. But I also want you to look at the relative strength, because while the AD line was going up, relative strength was going down. For those of you at Earnings Beats that follow that strong AD chart list, it's both. Remember, it's strong relative strength and it's also strong accumulation distribution. All right, everybody have a great day. Good luck on Tuesday. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.